Hello, welcome. My name's Ethan. Make sure to check out my website, ethanwrenn.com. From there you can find links to all my various socials. We are currently live on Twitch, YouTube, and the front page of my website. If you'd like to get notified when we go live next, make sure to follow or subscribe, and you will be notified. You could be here asking me questions. Also, join our Discord. It's completely free. You can do so on my website. What is it we're going to be doing today? Well, we're going to be looking at a video called What Stock Investors Can Learn from Company Earnings Reports, brought to you by the official TD Ameritrade account. Let's see what they have to say.
Imagine if every 3 months you had to report how much money you made, how wisely or unwisely you spent it, and how much of it you had left. And after giving your report, the financial world would judge your performance. That scenario sounds intense, but this is essentially what publicly traded companies do every quarter when they release an earnings report and hold an earnings call to talk through their financial results. Earnings events can be important to investors for 2 reasons. First, earnings events can have a significant impact on price and generate a lot of volatility. And second, they're a way for investors to understand a company's financial condition, which is the backbone of a successful investment. But before we get into those reasons, let's talk about what an earnings report is. Every quarter, public companies are required to report their financial performance to the SEC. A typical earnings report includes at least 3 main financial statements: income statement, balance sheet, and cash flow statement. The report is usually followed by a press release and public conference call where company management explains the results and answers questions from analysts.
Well, what do we like to see in earnings report? Rising revenues, rising profit margins over previous quarters.
And investors. While earnings reports include a lot of helpful information, investors generally focus on earnings per share, or EPS. Though no single number can tell the whole financial story of a company, EPS is considered one of the most important because it shows how profitable a company is. It's calculated by taking the company's net income and dividing it by the number of outstanding stock shares. At an earnings event, the actual EPS for the last quarter or year is released and compared to the company's expectations.
You guys often hear me critique earnings. I know you hear about all these more 5-minute candle Andes talking about how they love trading earnings and doing all this, doing all that. I critique them so much throughout my trading, throughout my videos, because of this concept right here. More than anything else, what is it that Wall Street and the headlines and what is it you always hear? What is the main takeaway from earnings? Boom, this stock beat expectations, or boom, this stock did not meet expectations. Well, what expectations? Whose expectations? Like, what do you mean? Like, clearly here, this would show rising EPS, or rising EPS. These expectations, more often than not, are just so arbitrary, right? You have a random analyst on Wall Street saying, oh, this is what I feel it should be. This is what I feel it should be. And for some reason, that feeling becomes the actual barometer as to whether earnings are a W or an L. A company could have rising revenues, rising profit margins, but oh, I'm sorry, guys, it didn't meet expectations, so we got to punish it. Or it could be completely unprofitable. It could be a company that's been unprofitable for the past 10 years, and their revenues just keep getting worse and worse, and their profit margins keep getting worse and worse, but it beat our expectation. It wasn't as bad. It wasn't as bad as we thought it was going to be, so I think no, dude, like the whole earnings game just it just gets ruined because of this concept of beating actual expectations or not beating actual expectations. Wall Street's kind of got it figured out. If they want a stock to rise, they're going to give it really soft estimates. If they want a stock to go down, they're going to be really hard on its estimates.
Also known as guidance for that same time period. The actual EPS is also compared to earnings estimates Wall Street analysts publish. These comparisons are where volatility can come in. If earnings beat expectations, it suggests that the company might be stronger than analysts thought. This can cause the stock price to rise. However, if earnings are below expectations, it suggests that the company might be weaker than analysts thought. This can cause the price to fall. This is why investors generally want EPS to exceed, or at least meet, expectations. When reported earnings are significantly higher or lower than expected, it's called an earnings surprise. The market tends to absorb this information quickly, so depending on the degree that earnings estimates were missed or exceeded, the stock price can jump dramatically. If you own individual stock, you'll usually see the biggest moves in your account around these announcements. These potential big moves are why speculators sometimes trade around earnings. In addition to potentially spurring volatility, earnings events can provide insight into a company's operations and values. During the earnings call, company's management typically explains why earnings met or didn't meet expectations. This is a chance for investors to evaluate the health of the company and determine.
This is an example of some important information you can sometimes take away from earnings is when you get on the calls and hear what the insiders have to say as to why they did well or why they did bad. They might say certain market segments of their company are outperforming. They might say certain segments of their operations are not doing good. They maybe had to hire more people. They invested more in marketing. This is a great way to get a really comprehensive understanding of what's happening on the inside of some of these companies that you may find value in.
Determine whether it's a good investment. You don't have to be an expert financial analyst to gain valuable perspective from an earnings event. Whether through your brokerage firm, financial news sites, or a company's investor relations website, it's easy to find earnings numbers online. Along with other forms of analysis, following earnings announcements can help you decide if an investment is right for you.
Well, I think that rounds out another great video from the official TD Ameritrade account. They do a really good job at explaining some of these core concepts that are very important to investors. Give me one moment. We're going to work into our next one.